Economists expect the interest rate to remain unchanged when the South African Reserve Bank's Monetary Policy Committee releases its statement this afternoon. In July, the committee decided to keep the repurchase rate at 8.25. Yesterday, the consumer price index data released by Stats SA showed an increase to 4.8% in August from 4.7% in July. Stats SA says the main contributors to last month's data were food and non-alcoholic beverages and housing and utilities. The inflation index measures the rate at which consumer prices increase. And to talk more about what this means for consumers and the economy, we're joined by Isaiah Mhlaga, who is the chief economist and head of research at Rand Merchant Bank. Isaiah, good to see you. Thanks for joining us.
Thanks for having me.
Yeah. So, Isaiah, let's take a look at it. Obviously, the Reserve Bank's governor, Lesetjo Kganyago, he's going to announce later this afternoon. So, but before we even get into the nitty-gritty, let's get a forecast. What do you think is going to happen?
Look, we think the SAB is going to hold rates unchanged at 8.25%. If you look at inflation at 4.8%, it's firmly within the target. Yes, we saw a marginal increase from 4.7 previously, but the difference between 4.7 and 4.8 is very small. Mm-hmm. And if you look in terms of the other factors that the SAB cares about, inflation expectations, they actually moderated for the third quarter. If you look at the US Fed decision last night, they also kept rates unchanged, even though they signaled, a higher for longer. That's what we would expect for the SAB, that even though they are not going to increase interest rates, they're not going to be in a hurry to decrease, these interest rates. That's why we expect only cuts to come in the second half of next year. The big concern is the risk premium that is going to come from the unsustainable fiscal or concerns about fiscal sustainability, of which we're going to know about on the 1st of November.
Yeah. Obviously, the CPI was released yesterday. Do you think this will have any influence on the Reserve Bank's decision with the announcement? And perhaps talk to us about that data.
Absolutely. It does have an influence to an extent. But the SAB worries more about forecast of their CPI rather than actual CPI. The 4.8% is a historical data. It matters to an extent that it influences inflation expectation. But what matters more is what they project inflation to be over the next 18 months or so. So the price of oil matters, the currency weakness also matters, the direction of the US dollar also matters, and all of those will continue to present risks. You would also know that at the current moment, oil is trading just about $95 per barrel, and it has been ticking up for some time. The currency weakness might come due to concerns about the fiscals, so that will continue to cause risk for fuel price locally. But the SAB will highlight those risks as upside, but still keep interest rates unchanged. That's our view.
Yeah. In July, the MPC decided to keep the repurchase rate at the current level of 8.25%. But when delivering that, the Reserve Bank governor was saying that 3 members of the committee preferred to keep the rates on hold, but 2 wanted to increase it by 25 basis points. Can we see the same happening again with the MPC members not in a full agreement this time?
It's quite possible to see a divided MPC as far as the preference is concerned. We would expect at about 4 members preferring to hold and perhaps 1 member preferring to hike. And that's because of the concerns about the upside risks from oil and potential currency weakness and the risk premium. But even a consensus is quite possible, given that inflation now relative to where it was in July, or even the forecast of the SAB at the July time relative to now, is quite changed. It's much lower now than then. So I would not discount the possibility of a unanimous hold in interest rates.
Yeah, and that's one of the things I suppose many people are going to be looking for, because times are tough. We can talk numbers, and we can sit and talk about, consumer inflation rising to 4.8% in August, and all of these kind of things. And obviously, these are the measures that the government look at and economists look at. But the reality is that people are struggling on the ground. They really are. We are talking about people that can't afford food, that cannot get by. They're in immense debt and, they need some relief somewhere. Obviously, this is taken into consideration, but a lot of the consumers don't feel that way. They don't feel that they are even thought of during this process.
Absolutely, Len. There are different impacts of monetary policy across, different segments of society. For those that earn lower income levels and still exposed to the debt market with the increase in interest rate that we have seen, they will be feeling the pinch. If you just take average house prices, for instance, from 2020 at the lowest interest rate level that we saw at 3.5% to where we are now, consumers are paying about 4,000 Rand more in debt servicing costs than they used to pay then. But that was not the normal level of interest rates. We have to accept that interest rate had to normalize somewhat. But also we had this increase in inflation, which actually hurts the poor because the poor do not have the instruments to cushion themselves against this high inflation, which is why we have to be thankful for a central bank that responds to this inflation much more aggressively to make sure that those that have lower incomes, their incomes can buy a little bit more rather than being eroded by inflation. So it's really a double-edged sword. If you borrow, you will be exposed to interest rates. If you don't have enough money, you will be exposed to inflation, and you don't have ways to circumvent its impact. But ultimately, we require low and stable inflation in order to have less volatility in economic activity that can then attract fixed investment and therefore can reduce unemployment rate when the economy grows, which this economy is not doing currently.
Yeah. I mean, if we look at consumer inflation, it has stayed within the Reserve Bank's target of 3 to 6% for a third consecutive month, which I suppose, what can we read into this? I mean, is it working? I mean, obviously what the Reserve Bank has been doing is perhaps working for what they're trying to achieve, but, whether it's being felt on the ground, from what we are hearing and seeing, it certainly doesn't seem that way. But for them, their mandate, it's working.
Absolutely. I mean, inflation was above 7% a couple of months ago. Now it's at 4.8%, and it is within their target of 3 to 6%. I think we should not confuse issues. Inflation, prices are not contracting. They continue to rise, but they're rising at a lower pace relative to where we're coming from. So we are still seeing the cost of living increasing. It's just increasing at a lower pace. So we will feel that at a personal level that prices continue to rise from month to month, or from relative to last year, they continue to rise, but they're rising at a slower pace, which means our money is not being eroded in terms of its value quicker than it used to be eroded in the months that have just passed.
And yet we still see the currency struggling. Obviously, there are a lot of factors that influence it, but we see the currency struggling, which is, I suppose, in question. And also, I mean, if we look at the price of petrol, again, moving higher. I mean, we sat with going up R1.43 a litre, with more fuel increases predicted for next month as well. I mean, not to mention what diesel is costing at this point. So, this is something that needs to be taken into consideration too, and how this will push inflation up.
Absolutely. The currency is influenced by a lot of factors. Our own analysis suggests 60% of the impact on the currency are domestic factors, and some of them are non-fundamental, which means they're not related to the operation of the economy itself, but it's sentiment-driven. You would remember in May, we had the diplomatic fallout of the South African government with the US government. The currency sold out significantly. But we now have concerns about the fiscus. The finance minister and his staff have been highlighting that we have an unsustainable fiscus, which means when investors look at South Africa, they are not, quite positive. In the sense that they're not seeing better economic growth, reduction in unemployment rate in the next couple of years. And as a result, they are not willing to lend South Africa money, at cheaper rates. They would ask the South African government to pay up in order to lend us money, which means that risk premium is now also embedded in the currency, which is going to be a risk for inflation going forward through higher petrol prices, in addition to the high oil prices that we have seen in the last few weeks.
Yeah. So in July, the Reserve Bank's forecast for global growth in 2023 was revised marginally higher to 2.5%, and that I think was from 2.4%. Do you expect this forecast to change after yesterday's CPI data and the global geopolitics, including what's coming out of the United Nations General Assembly at the moment?
Last night, we saw the U.S. Fed revise economic growth for the U.S. slightly up. But on the other side, China's economy has been underperforming. The stimulus that we have been expecting from China has been coming, but only on the margin, particularly on monetary policy. Fiscal stimulus remain largely absent, which means there is going to be, pressure on commodity prices, which have bailed out our fiscus in the last 2 years. And in fact, if we don't see commodity prices recover, it's going to weigh heavily on the South African economy. But we also have other domestic constraints, things such as the unavailability of the railway sector to enable the bulk mining companies to transport their mining commodities to the ports. And if you talk to some of the mining companies, they have been reducing production because they sit with high inventory levels, which they can't ship to the ports, which means economic growth is constrained by those domestic factors that needs to be removed and removed quick, and it's not happening. So those are some of the constraints that would, result in lower growth locally, because also globally, China's economy is not performing as it should. So we have, a double whammy. Global growth is not performing domestically. Even when global growth is better, we have constraints that are, preventing the South African economy from growing.
Isaiah, just one or two more questions, and as we wrap up, how about the country's energy and the whole issue around load shedding? I mean, we've been really struggling. It has been a very, very tough time for us, and certainly this is hampering economic growth. And we're seeing businesses struggling. They're shutting down. They can't handle at stage 6, and it somehow feels. I mean, we just heard news yesterday, coming out that, after 9 months, we still don't have a CEO of Eskom, ever since Andre de Ruyter left. We've been plunged to stage 6 load shedding for the last week or so. And, obviously now it gets a bit quieter and then suddenly it comes back. But there's never a solution in sight. And this has to hamper a lot of development within the country. So, how do we balance this into all of it? And what is the economic outlook with regard to our electricity and load shedding?
Look, load shedding has been a constraint for a very long time. Coming into this year, we have been expecting load shedding to be much more intense, and indeed it was more intense than what we saw last year. But if we look at economic growth in the first quarter of this year and second quarter of this year, it has surprised on the upside. And in part because the private sector and households have been building their own alternative energy sources, and as a result, the economy has been resilient. A lot of our clients that we speak with, they also tell us that they've invested quite heavily in alternative sources of electricity. Eskom's own survey of households says they have added about 4.4 gigawatts of energy through rooftop solar panels, inverters, and batteries. And you can also see this in imports. If you look at the private sector, particularly for the manufacturing sector, would have expected manufacturing to nosedive as Eskom's supply of electricity has been moderating. But fortunately, it has been resilient, and in part because of the own energy solutions that the manufacturing sector have been building. So that, in a way, resulted in better than expected economic growth, in the last 2 quarters. Going forward, our expectations would be that load shedding will increasingly have less and less of a big impact on economic growth as corporate sector, build resilience and adapt. But that is not to discount the fact that load shedding is a big constraint in actually preventing job creation and investment in the economy. What companies should have invested in expanding the productive capacity of the economy, they are now investing in energy solutions. So it's actually a hindrance or a constraint on the extent to which they can grow this economy and create jobs.
Okay.
So it needs to be ended as quick as possible, but so far it remains a problem for quite some time.
All right, we'll leave it there, Isaiah. Thank you very, very much for that. And we'll see what happens. 2 o'clock this afternoon, interest rate decision. But of course, it's looking like things will stay on hold.